overall stock market measured by the S&P 500 has been going up pretty much in a straight line, and now it's like again near all-time highs. But under the hood, you notice that there are some stocks that seem to have gone on sale recently. Their stock price has dropped pretty significantly, especially after announcing earnings. So examples would be stocks like Adobe that dropped after earnings, right? It dropped after earnings. You have got stocks like Tesla that have also dropped quite a bit. In fact, it has been dropping for the last year or so. And then you have got stocks like Lululemon that also gap down significantly after earnings. You have got even stocks like Accenture that has dropped significantly as well. You have got Palo Alto, which is the cybersecurity stock that has dropped quite a bit after earnings as well. So it looks like there are quite a number of these stocks that seem to be on sale, even though the overall market has been going up. Now, most investors, they look at stocks that have dropped recently, and you'll be thinking, would this be a good buying opportunity? I mean, that's what investing is all about, right? You want to buy low and then hopefully sell high. So as an investor, how do you decide that a stock that has dropped is worth investing in? Just because a stock has dropped doesn't make it a good investment. So for me personally, there are three questions I ask myself. The first question is, in the first place, is it a high quality stock? Remember, when you buy a stock, you're buying essentially a piece of a business. So is it a high quality business? Because if it's a low quality business, I don't care how much the share price drop, I ain't gonna buy it, because cheap crap is still crap. You only want to buy something cheap if in the first place it's a high quality business. So to answer that question, you need to have a model. And for many, many years, I've used what I call this framework of what makes a great business. What makes a great business model? And there are many things I look at within this model. For example, a great business is one that should be able to keep growing without having to issue new shares or raise debt. They are self-sufficient in growing their business, and ideally if they can buy back their own shares, and they have got a conservative debt structure, they don't have too much debt, right? Other things I look at would be the actual business model, which is I like businesses that have as little input cost as possible. All right, so I avoid companies that have a lot of high input costs, a lot of high infrastructure and capital equipment costs. And that's why I tend to avoid manufacturing companies. I avoid oil and gas companies. I avoid auto manufacturers. I avoid property developers, because they need a lot of capital equipment, a lot of infrastructure to maintain and to scale the business. I don't like that, right? Because it drains a lot of the cash flow. I avoid companies that have a lot of key man risks, like everything depends on this one guy. If that one guy's on drugs or he hits by a car, then the whole business is gone. Right? Ideally, you want to own a business where no one cares who the CEO is. Like, do you care who the CEO of McDonald's is? I don't care, right? I mean, he can die tomorrow and McDonald's will keep going on, because a great business ideally should be able to continue doing well even if the CEO gets hit by a truck. All right. And then output. You want a company to be able to maximize their output in terms of, are they able to command high pricing power? Are they able to keep raising prices every year above inflation without losing market share? Right? That's a great business. If the business has to cut price in order to protect market share or in order to maintain market share, that's a lousy business. Okay? Are there high switching costs? Ideally, I want businesses that have got a lot of recurring income, right? So I like subscription models, like software companies, for example. So when a company has got low input costs and high output, high pricing, that leads to increasing gross profit margins and operating margins. That's good business. Other things I look at, now, to me, the most important thing I look at is I want to make sure the business I invest in is able to protect itself from competition. In other words, competitors are not able to easily take away their market share. Competitors are not able to easily take away their customers. And the only way they can protect themselves is if a company has got what we call a strong economic moat to protect it, a sustainable competitive advantage. This comes from having a very strong brand that's almost a monopoly. I like to invest in monopolistic companies. Companies with high customer switching costs, where the customer finds it very difficult to switch to another competitor because they are locked in to the software or to the network, right? Huge economies of scale, high barriers to entry. These are all the things I look at. And you know something, guys? In the past, it took me many hours to read the annual reports, to read articles, to do research, to analyze a company's business model. Today, I can analyze a company's business model in depth in a matter of minutes. How? By using the power of AI. Right? That's right. So nowadays in my investing course, my Whale Investor course, and my Wealth Academy Investor Masterclass, I teach people how to use the right prompts using ChatGPT or Google's Gemini to analyze business models, to know that it's a great business. All right. So let me give you a very quick example. So for example, one of the companies that I have invested in for many years, and I just bought more shares, is United Health. United Health is the largest managed healthcare company in the United States. And again, in the past, I used to take hours to analyze the business model based on all those things that I showed you. But using the Gemini from Google, their AI, straight away it's able to tell me that United Health has a wide economic moat of 7 out of 10, right? So 10 is the strongest moat, 1 is the weakest moat. So the rule of thumb is I only invest in a business where their moat is at least 7 out of 10. At least 7, right? Less than that, I wouldn't dare to invest in it. I may trade it as a short-term trade, but I wouldn't invest in it. And then it breaks it down to say, for United Health, where does the moat come from? All right. So brand loyalty, 7 out of 10. Higher barriers to entry, 8 out of 10. High customer switching costs, 6 out of 10. Network effect, 5 out of 10. Economies of scale, 8 out of 10. And they also talk about what are the current challenges that they face, like antitrust investigations and a potential economic downturn may affect employer-sponsored insurance plans. So, this AI is amazing. That's why I'm so bullish on AI changing the world, because I use AI every day to analyze businesses, and it's made me a lot more productive. So if the stock you're looking at passes the first criteria, that it is a great business, then the second question to ask is, why did the stock price drop? Now remember that stock prices drop for all kinds of reasons. So they could be non-company specific reasons. Like sometimes the stock price drops, it's got nothing to do with the company. It's because the Fed suddenly said something stupid, or because there was a war going on. So these are what we call non-company specific reasons, like macroeconomic and geopolitical reasons, like wars, recessions, changes in interest rates. And then of course you may have an overall market correction where everything goes down, or bear market, everything goes down. The good, the bad, ugly, they all go down together. Sector rotation, industry-specific news that hits an entire industry. And of course, stocks can also go down for no reason except for market manipulation by market makers and algos. Bastards, right? But I love them. They give me opportunities to buy great companies at discounts once in a while. And then a stock can also drop because of company-specific reasons. Some news about the company. And it can be all kinds of reasons, right? Like the company misses their earnings estimates, or it could be the company beat earnings, but they issued lower forward guidance. In fact, that is what caused many stocks recently, like Lululemon and Accenture and Adobe and Palo Alto, to all drop. They drop because of this reason, lower forward guidance. And sometimes a stock could drop because of a cyclical slowdown in the demand for products and services. It's just a short-term slowdown, but you'll pick up in the medium to longer term. Temporary bad news, like a lawsuit, a sex scandal. Recently, Google was sued, Apple was sued, right? And that's why the stock price dropped because of this reason. A major shareholder was forced to liquidate. Manipulation by market makers and algos. So the whole point is this: if a stock drops because of all these reasons, reason 1 to 9, I'm a buyer. Why? Because these 9 reasons the stock dropped are all temporary reasons. Okay? But if the stock price drops because of reason number 10, then you don't want to buy. You want to sell the damn stock. Because reason number 10 is not a short-term reason it dropped. It's a long-term structural problem. In other words, it is when the business model has deteriorated or the economic mode has deteriorated. So you know that in the long term, they will not be able to rebound in terms of their sales, their margins, and their profitability. So that's time you have to get out of the stock. So you got to know the reason it dropped. Is it reason 1 to 9 or is it reason 10? Okay. So like I said, reason 10 is a structural long-term problem that has affected great businesses before. That they used to be great, like Nokia, Blockbuster, Kodak, Yahoo, AMC used to be great, but now they are no more, or they are no longer great, right? Because the economic mode deteriorates, permanent disruption of the business model, or a permanent change in consumer behavior. So you got to know this stuff, right? So that's the second question to ask. Third question to ask is, okay, so the stock drop is a great company, it's the first 9 reasons, but did it drop enough? Sometimes the price may drop, but it's still overpriced, it's not undervalued. So you got to wait for it to be undervalued, then you know that you are a buyer. So let's take a look at a few examples to see if these stocks are on sale and are they worth investing in. Again, this is not a recommendation for you to buy. This is just shared for educational purposes and just to tell you that I've bought some of them, right? So the first stock is United Health, and United Health is the largest managed healthcare company in the US. So first, is it a high quality company? Well, I think so. It passes all my criterias of being a great business, having a great business model. In fact, again, using Gemini from Bard, I showed you earlier on, where's my Gemini? There we are, right? So United Health has an economic mode of 7 out of 10, which is considered great. Now, like I said, higher the better, but at least number 7. Then the next question is, why did the stock drop? Is it reason 1 to 9 or was it reason number 10? Well, the reason the stock dropped was, actually there were 2 reasons it dropped, right over here. The first reason was because they were hit by a cyber attack. Okay, and I heard they paid $2 billion to the hackers just to get the information back. So that's the first reason the price dropped. Now, again, is that a temporary reason or is that a structural, permanent change in their business model? It's temporary. Second reason it dropped was because a recent lawsuit was launched against United Health by the government for being a monopoly. It sounds familiar? Yeah, so the lawsuit was launched against Alphabet, Google, Apple, and United Health. And in my recent video, I did share that, again, all these things are always temporary. So reason it dropped, temporary. All right, so passes the first 2 reasons to buy. Third reason, is it undervalued? So that's where you have to learn how to calculate the intrinsic value. So again, in my investor course, I teach my students how to calculate the intrinsic value using my intrinsic value calculator. It takes less than 10 minutes. I take 3 minutes because I'm good. Right? And of course, if you subscribe to my Ultimate Investors Playbook, then I calculate all the intrinsic values for my subscribers and they're updated regularly, as well as, my buy levels, right? So for United Health, you can see that if you put in, the most recent net profit or free cash flow and their debt levels, their projected growth rate, the intrinsic value is $565, right? And in fact, you can see this green line over here, 565, this green dotted line, that's my intrinsic value. And basically I derive that from my own, sorry, that's another stock, from my own valuation. Where did I put it? There we are, right? From this valuation over here. And the current share price is $490. So is it undervalued? Yep, it is undervalued by 13%, right? So is United Health a buy based on these 3 things? Yes, good company, drop for short-term reasons, undervalued, it's a buy. And again, what I tell people is when I buy, I don't buy at just one go, right? I average in the position. By the way, I have been holding United Health for many, many years, and for me, it's just adding a bit more to the already existing position. And I also look at the technicals to identify levels to buy, ideally at a strong support level. So for example, you can see over here, this was a previous support level over there. So when it bounced off the support level over here, that's where I added some more shares. So it looks like it may bounce up from here. There's no guarantee, of course, it can go a bit lower, but this looks like a pretty good entry level for me. Another example is Adobe. For some reason, a lot of you have been asking me about Adobe from the comment section, so I thought, okay, let me talk about Adobe. Okay, so I own Adobe as well. I've owned it for many, many years, and again, number one, is it a great business? Yeah, passes all the criteria. Again, look through all these things that I showed you. And again, if I show you the on Gemini, you can see Adobe has a mode score of 8 out of 10. So the economic mode is very, very strong for Adobe. The mode is strong with this one, right? So you can see brand loyalty and pricing power, 8 out of 10. High barriers to entry, 7 out of 10. High customer switching costs, 9 out of 10. Network effects, 7 out of 10. Economies of scale, 8 out of 10. So that's why it's got a very high mode score of 8 out of 10. It's a fantastic business. Then question is, why did it drop? Let's look at Adobe. Why did the price drop? Why? What's the reason? Because of earnings. But again, did they announce bad earnings? No, they announced great earnings. So they beat on revenue, they beat on earnings, but why did the price drop? Because they lowered their forward guidance, where they're saying that, okay, for the next year, we're going to do this much, and you're slightly lower than what people expected. So the stock tanked, right? And that's a great reason to buy, in my opinion. I'm not asking you to buy, I'm just saying in my opinion. Why? Because remember, companies always like to lower their guidance so they can beat it later on. It's kind of like having a kid, and you're asking your kid, how are you going to do on your coming exam? And they go, Dad, Mom, I don't think I'm going to do very well, right? They always lower your expectations, and then when your kid does okay, they get a B. You're like, oh, you're so smart, you're so good, you get a present, right? Companies do that all the time. So whenever a company announces good results like Adobe, but they lower their forward guidance and the price drops, to me, that's a gift. It's a gift to the investor who wants to buy more shares, right? And the third question is did it drop enough? Okay, so I did a most recent valuation of Adobe, and the recent valuation is $499 intrinsic value, and the share price dropped to exactly $499 as well. Right, so it is right now at the fair value. So in other words, it is not expensive. It is not cheap, it is fairly priced. So anything wrong buying a great company that's fairly priced? Well, of course, there's nothing wrong. But if you want to get a bigger margin of safety, a better deal, then I would wait for it to drop to maybe the next support level at 471 or at 433 to add more shares. All right, because right now it's not that cheap, right? Of course, here it's a bit overpriced, and then again, what goes up will come down, right? Remember, wave up, wave down, wave up, wave down, wave up, wave down, right? Follow the wave patterns. So that is Adobe. All right, next example, Palo Alto. Palo Alto is one of the top cybersecurity companies in the world, in the United States. And again, it had a drop recently. What caused the drop? Again, same reason as why Adobe dropped. They announced earnings that was very good, but they lowered their forward guidance and the market lost its shit. Right, big drop over there, right? But again, first question, is it a high quality business? I think so. It's a great business. By the way, I already own Palo Alto, right? And I'm looking to add more shares in the near future. So again, if you go to my analysis on Gemini, you can see for Palo Alto, the overall mode is 8 as well. So again, it's a very strong business, 8 out of 10 economic moat with strong pricing power, 7 out of 10, barriers to entry, 8 out of 10, high customer switching costs, 9 out of 10, network effect, 6 out of 10, and high economies of scale, 8 out of 10. Great business. So great business. It dropped for the right reasons, but is it cheap enough? Well, not really. Well, it was for a while. So in fact, I bought here. Yeah, baby, I bought there. And of course, this was alerted to all my UIP subscribers, and many of them saw exactly when I bought in, right? So this was really a gift for investors. But since then, it went up, and then now it's beginning to retrace back down a bit. So the intrinsic value of Palo Alto, I don't have the, was it here? No, I don't have the valuation here. It's somewhere in my files. But anyway, so my intrinsic value is about $267, and it's now at $286. So it's still a bit overpriced. So think about it. When it was here, it was bloody expensive. And for a moment, it dropped just below the intrinsic value, which is my green line there, and that's why I jumped in to buy, and then it went up, and now it's kind of like consolidating. So anything wrong with adding more shares here? Well, if you're buying here, you're buying it a bit expensive. So of course, I would rather that it could drop below the valuation more. If it can go to 242, 213, I would really, buy like crazy, even more shares, right? But I started buying here when it just got a bit undervalued. So that's Palo Alto. Okay, how about PayPal? Now, PayPal has been down for quite a while, right? In fact, recent earnings, it dropped as well, but rebounded from the earnings. But same thing, PayPal actually announced good earnings. They beat on revenue, they beat on profits, but they lowered their forward guidance, so it dropped temporarily, but the market has since rebounded from there. Now, the thing about PayPal is that when I analyze it as a business, I don't find it a very high quality business because I think that they've got a lot of competition in the space, and their economic moat is not that strong, in my opinion. Okay, so for me, PayPal is a business that I won't invest in for the long term, but I may buy it for a short-term trade. So again, to me, in the world of stocks, only 1% of stocks are investable. These are like the people that you want to marry. They are fantastic. They're the best in the world. 99% of stocks are not good enough to marry, to invest in. But you can trade them. You can go for a date. You can go for a one-night stand. All right. So to me, PayPal is kind of like a one-night stand. Yeah. But is it worth buying as a one-night stand? Maybe, not too bad. So I recently did an intrinsic value calculation on PayPal. Where's my PayPal? There we are. And yep, so based on the most recent free cash flow and projected growth rates, I value it at about $86. And right now it's at $64, so it's 25% undervalued. All right, so it is cheap. And I am maybe looking to buy more like a short to medium term trade, but I'm not going to hold it too long because I think there's a lot of competition that could eventually take away more market share. Now, if I take a look at the technicals of PayPal, you can kind of see that for quite a while, it was on this downtrend, and it couldn't break this 50 moving average on the weekly candles. You can see every time it hit the 50, it came down. Hit the 50, it came down. And here, hit the 50, came down, right? It couldn't break that 50 moving average. But recently, it looks like it may have bottomed, right? So you can see now this candle is still forming because this is a weekly candle, and right now it's only Monday, so we have to see how this candle closes, right? But there is a previous swing high here that may act as resistance. So for me, if I'm looking at a short-term trade, I want to make sure that it's able to break above this previous resistance before it can have more upward momentum. All right, so would I buy right now, right here? Not yet, right? I am not convinced that it is a reversal, a breakout, until it can break and close above the $68 level. So that's on PayPal. All right, finally, let me talk about my favorite stock, which is Tesla. And Tesla's been down for quite a bit, almost a year. And again, some people think that it's on sale. But again, the first question is it a high quality business? And some people get very emotional because they love Elon Musk, whatever, right? But I believe let's be really, really objective. And if you take a look at, again, this model over here, for me, I've got a few concerns. The first concern is, of course, the automotive business. Some people say it's not a car business, all right, but they make their money selling cars, at least for now, right? There's a lot of infrastructure and capital equipment. There's key man risks, right? A lot depends on the guy, and this guy's on drugs as well, right? Their pricing power is not that strong. They have not been able to raise prices. In fact, they've been cutting prices in order to protect their market share in China especially. And do they have a very strong economic moat? Well, I don't think so. And if you take a look at the analysis from Gemini Bard, you can see that for Tesla, their moat score is 6.4 out of 10, which doesn't pass my criteria of being at least 7, right? So you can see that for brand loyalty and pricing power, they actually get a 7 out of 10, actually, right? Among enthusiasts for Tesla, all right? So there is some pricing power, but recently this has degraded, right? Especially in China, right? High barriers to entry, yeah, 8 because of their technology, give them 8 out of 10. High customer switching costs, 5 out of 10 because you can easily switch cars if you want to buy another EV. Network effect, 3. Economies of scale, 9, right? So overall moat score, 6.4. Okay. Then the second question is, why did it drop? Did it drop for short-term reasons or longer-term reasons? And it dropped because of the recent decline in gross profit margins. It dropped because of the sales slowing down. Now, of course, now at this point of time, it's still hard to judge. Is it a short-term slowdown? Will it rebound? Or is it a longer-term structural problem, right? I think it's too early to judge. But give it the benefit of the doubt. Let's say it's a short-term slowdown and it will start to rebound. Sales will re-accelerate again in the future. But then the third question to ask is that, okay, has it dropped enough? Is it undervalued? Okay, so it depends on the kind of numbers you use. And for me, now, if you look at Tesla, for example, you can see the free cash flow is 13 billion. That's the operating cash flow, right? You take 13 billion minus the capex of 9 billion. Basically, the free cash flow is 4 billion. And if I put in 4 billion into the free cash flow, my intrinsic value will only be $50, which I did mention the last time. So I thought, okay, let's be very lenient and let's not even take in the capex, right? Let's assume that their capital expenditure is zero capex, and we take the full cash from operations to value the business, right? Which is $13 billion, 13,256. So I put in the full operating cash flow without deducting capex, put in all the rest of the metrics that you can get online, and that gives an intrinsic value of $131. So even with the drop over the last 1 year, it's still not cheap, right? It's at 170, so it's still overpriced even with this valuation. Okay, so essentially that is how I make decisions as an investor on whether to buy a stock that has dropped. Hope it's been useful. If you've got questions, leave them in the comment section, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com, where you're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.